All right, this day we're at the Kauai Beach Club. We're hitting all the beach clubs this week. Now, what is the return on equity for the Kauai Beach Club off of income of $490? First off, let's understand that the return on equity calculation helps shareholders understand how much dollar of income was earned per their dollar of investment, right? So they want to earn more dollars on a lower investment. That gives them a higher return. So we want as high of a ratio as possible. Now, the formula is quite simple. It's just net income divided by average shareholders' equity, right? So we already found the $490 of net income. Now, what's average shareholder equity? Fortunately, they gave us the balance sheet. It gives us shareholders' equity, right? Last year was $200. This year's $200. Average of both of those, obviously, is $200, right? So we take $490 of net income, divide by average shareholders' equity of $200, and we get 2.45, right? So that's the return on equity for the Kauai Beach Club. So 2.45 is the correct answer.
Equivalents have a maturity of 3 months or less.
So in this question, we have Heather. She's the CFO of Hawaiian Ventures, right? And they're thinking about acquiring Golden Wave Beach Club. I don't know what their strategy is, but it seems like they're trying to acquire all the beach clubs in Hawaii, which that'd be an awesome company to work for. So she needs our help to calculate the inventory turnover ratio for year 5, right? So on the top right of the screen, we've got the inventory turnover ratio. Now, think about it for a second. So the inventory turnover ratio measures how many times the company goes through the inventory and they sell it each year, right? So if the ratio is 12, that means they turn it over 12 times or once a month, right? So it takes them, let's say, 2 weeks to produce it and then 2 weeks to sell it. Now that's a decent ratio probably, right? But some companies are going to have higher. So anyway, when it comes to the inventory turnover ratio, you want that to be as high as possible. So as you can see, the formula is quite simple. It's just cost of goods sold divided by average inventory. Now, assuming the question gives us both pieces of information, yeah, we can solve for it. But what if they don't? Right? Well, this question does give us cost of goods sold for year 5 of $150,000, but it doesn't give us average inventory. However, all average inventory is last year's ending balance plus this year's ending balance, and then you take the average of those two, right? So we can see they've got 45,000 last year at the end of year 4, right? Now at the end of year 5, they have 60,000. Well, the average between 45,000 and 60,000 is 52,500. So let's solve for the inventory turnover ratio now. So we have cost of goods sold of 150,000, and then we have average inventory of 52,500. When we divide average inventory into cost of goods sold, we get a ratio of 2.86, and that's the correct answer. We're absolutely just crushing the beach clubs, right? We're at another one. This one's in Kona. Kona is a beautiful spot as well. Unfortunately, what we're going to have to talk about at this beach club is the quick ratio, right? Everybody's favorite topic. Go up to anyone in the bar, start talking about the quick ratio. I'm sure they're going to buy you a drink. So there's really 2 things to know about the quick ratio. The first thing is the exam could also call it the acid test. So know that they're synonymous, right? And then the second thing is to know that it's the most extreme liquidity ratio because it excludes certain current assets that aren't all that liquid, right? Like inventory, prepaids, other current assets, right? As we can see in the top right, the formula for the quick ratio is cash plus receivables, right? Which is accounts receivable plus marketable securities, right? And then we divide that by total current liabilities. And that includes all current liabilities. So in the question, they give us the Kona Beach Club balance sheet, right? There's a few items on there. Let's go ahead and plug them into our formula. So on the right at the bottom, I've got the adjusted Kona Beach Club balance sheet. And as you can see, I went ahead and I excluded inventory and prepaid expenses because as we discussed, those are not included in the quick ratio. So what we're left with for year 1, right? That's what the question's asking about, is $800 of cash, $300 of accounts receivable, and that totals to total current assets of $1,100, right? And then we divide that by current liabilities of $200. Well, that gives us a quick ratio of 5.5. And that means they have 5 times as many current assets as they do current liabilities. So yeah, it doesn't seem like they're going to have a problem in paying their short-term liabilities. So the correct answer for this question is 5.5. All right, so for this question, we're going to be kicking it at the Maui Beach Club, right? And unfortunately, we're going to be talking about current ratios and quick ratios. Now, they're very similar, right? The current ratio, as you can see in the top left, is just current assets divided by current liabilities. It's the most simple form of analyzing the balance sheet. Now, while the quick ratio is similar to the current ratio, it's a better metric to use to understand a company's liquidity, right? Because it only uses cash and cash equivalents as well as accounts receivable in the current asset figure. So the main difference between the current ratio and the quick ratio is that the quick ratio would exclude inventory, prepaids, and other current assets, right? That would be included in the current ratio. Now this question says that Maui used all of its cash to reduce its account payable balance, right? And we need to figure out how that impacts their current ratio of 1-to-1 they had previously, as well as a quick ratio that was previously less than 1. So what I would recommend for this is set up a fake balance sheet that has these ratios, right? And then we can assess the impact of that transaction on the ratios and then see how the ratio actually changes. That's the best way to do it. Now, some people, they can visualize all this playing out in their mind and they don't need to do that. But I'm going to do it for this question so that we can visually see how those ratios are impacted. So on the top right, we'll start with the example current ratio, right? So what I did is I plugged in 5 for cash, accounts receivable has 4, and then inventory has 1, right? So total current assets of 10. Now we have to make sure that the current liabilities match because the ratio is 1-to-1, right? So for accounts payable, 5, other current liabilities, 5. Now you can see the current ratio before the payoff is 1, right? That's the same as 1-to-1. Now the next step is to apply the cash payment, right? So we subtract out 5 of cash and 5 of accounts payable because it says it used all of its cash to reduce its account payable balance. So after payoff, right, we're left with 4 for accounts receivable, 1 for inventory. That's 5, right? Same thing on the current liability side, right? We just have other current liabilities of 5. So that gives us a current ratio of 1, meaning there's no impact to the current ratio. All right, so now on the example quick ratio, right, it says it's less than 1. And as you can see using the same numbers, the only difference is that inventory is excluded. So we have total current assets of 9 and total current liabilities of 10. That gives us a quick ratio of 0.9. And yes, that's less than 1 as the question states. All right, so doing the same thing with the cash payment, we're reducing cash by 5 and accounts payable by 5. And what we're left with is total current assets of 4 compared to total current liabilities of 5. And now you can see, right, the quick ratio is 0.8, meaning the ratio decreased. So the correct answer is no impact to the current ratio and decrease to the quick ratio. Now on the exam, I would be surprised if you had a question that's this difficult, but we prepared for it. We know the ratios, we know the formulas, we know how they work, and we know how movements or transactions can impact the ratios. So you're all set and ready to go. So in this question, we're focused on Kauai Brewing Company. Yes, another brewery in the great state of Hawaii. Gotta love it, right? And we're focused on the accounts receivable turnover ratio. So as you can see in the top right, for average accounts receivable turnover, the formula is credit sales divided by average accounts receivable. So we have credit sales of 1.5 million. The question gives us that. But we don't have average accounts receivable. But they do give us a year 1 balance of 100,000 and a year 2 balance of 120,000. So if we take the average between those two, it's $110,000. So now that we have both inputs, let's calculate the average accounts receivable turnover. All right, let's get this question to the finish line. So we take sales of 1.5 million, divide by average accounts receivable of 110,000, and we get an accounts receivable turnover ratio of 13.6 times. And that's the correct answer.